Hey, welcome back everyone. This is episode 2 of Optimal Trade Entry. We are in volume 2. This is an NFP drill. We are looking at the British pound and Japanese yen on the M5 chart. This is a non-farm payroll or NFP drill. So let's jump right into it. So typically on a non-farm payroll release day, we get a very specific manipulation. It usually takes out one side of the marketplace first before going into the opposite direction. So if you have any experience in this type of news trading, you'll quickly realize that these patterns are predictable, and you'll always see the smart money footprint at work. So what you'll get is typically the 2 days prior, Wednesday and Thursdays trading before the Friday that is a non-farm payroll. Wednesday and Thursday you'll get consolidation formation, and it's very specific because it will usually build up open float, and this is to create sentiment. This way we get we get a very specific manipulation, and they usually run it the same way every single time. So right now I have my annotations off. I'll go ahead, you guys can look at this chart here, and then I'll go ahead and turn them on. Alright, this is the non-farm payroll drill. We are going to go over this. Again, this is volume 2 of the Optimal Trade Entry. So, as I mentioned in the previous episode, we are going to be looking for specifically that time window where the New York Optimal Trade Entry is formed. So we have that 8:30 to 11 a.m. New York time. This candle here, this is the non-farm payroll release. As we can see, we have a swing low here on this side. So what price does, it comes down, takes out the sell side, it's cleared here, comes back up. As soon as we break this candle's high here, we get a shift in market structure, strong displacement higher, come back down into, this is a bullish order block. These last 1, 2, 3, 4, 5 down close candles, consecutive down close candles before the move up, form what is our bullish order block. And then as soon as we come down, we get another formation of these last 3 consecutive down close candles before getting another strong displacement higher. What price does here, we take out this swing high, but we leave these equal highs here, and then this high here in the form of a low resistance liquidity run. So at this point, we're expecting price to run these highs here, but we wouldn't jump in right away up here. What we'll look for, as mentioned, this is optimal trade entry. So what are we looking for? If we're looking for buys, we are looking to buy at a discount. So let's go ahead and put our fib on it. We're going to anchor our fib from this swing low up to this swing high. So the reason we picked this swing this swing low here, is because this is our current dealing range. From this swing high, this swing low, up to this swing high is our dealing range. We are currently in the New York session, and if we anchor this fib from this low up to this high, we extend that out, we get a very deep retracement. We overshoot the 79% retracement, but look at the candle bodies. The candle bodies are respecting that 70.5. So our entry for this model, it will always be at the 62%. So we get a little bit of drawdown here, but remember our stop loss is always placed below the swing low where we anchored our fib. So our stop loss would be down here or at that swing low, and we are looking for price to take out the buy side liquidity. So we can see here, price comes down into this order block here, these last 3 consecutive down close candles before this big move up. We call this a propulsion order block, and I'll explain that right here in a second. I have a diagram that I want to show you guys. Some of you might have heard of propulsion order blocks. Some of you might have not, but I think if you know how to use them correctly, they're a very powerful tool that you can add to your toolbox and potentially add them to your model. So as we can see here, price comes down into a a discount. Price starts to trade higher. We take out the buy side. We get another optimal trade entry here. So the way we would anchor that here, this swing low, we got another little bullish order block here. This swing low up to this swing high. We stand that out, and you can see price comes into a deep discount, but look at the candle bodies respecting the 79% retracement. Perfect delivery. We get a little bit of consolidation here, and then price eventually trades higher into the close. So this was Friday's trading. Now you don't have to be in this move here, this whole move. This is a big move here. You can get in at this 62%, and if you take out that buy side here, you're expecting to get a run on this swing high here. Show you guys how many pips are possible here. So you're looking to get out above the buy side liquidity. So you're looking at about 60 pips all the way up to around 70 pips. So very nice clean move, and you're looking at about, say your entry was here at the 62%. You're looking at a trade that played out in around 30 minutes. So nice scalp, nice intraday trade after the news release. So we don't jump in right at the non-farm payroll. We wait for that manipulation, then we get that obvious displacement. We are looking for price to respect the PD arrays. So this confirmed here that our institutional order flow was bullish. We have these last 5 down close candles. We get a nice move up, very sharp move up, come back down. Last 3 consecutive down close candles, get another move up. This to me indicates that we are now in a buy model. So as soon as we do this and come up here, we stop just shy of this swing high right here. We take out this one, but we stop just shy of this one and these swing highs here and this swing high here. Notice how we have that low resistance liquidity run. Price comes down, optimal trade entry, propulsion order block, propulsion bullish order block, and we get a nice move higher. So I'm going to go ahead and take these candles off the screen here, and we can look at what a propulsion order block is. So this is what we saw here. So a propulsion order block is an order block that will propel price higher, as taught by ICT. This is one bullish order block formation here. So if we anchor this trend line to the candles open. This is the candle down close candles open. We start trading higher, come back down into this bullish order block, and we start trading higher here. What happens here is we will get another bullish order block formation. Look at how this bullish order block here, the second bullish order block here, forms inside of this bullish order block. So we're kind of think of we're stacking bricks here. One bullish order block here. We get a nice down close candle, get a move up, we come back down, get another formation of a nice down close candle, another bullish order block, and we come up. So as soon as we come up here, we trade above this candle's open, as soon as we come back down here, we are expecting a nice run up. And the reason for this is because we are getting supporting PD arrays for a bullish institutional order flow. So when we come back down into this second bullish order block, which is our propulsion order block, we are not expecting price to trade below the mean threshold of this this candle's body. So around the 50%. So it's around here. You guys can eyeball that. Our stop loss will always be safe for this model below the swing low. So below the swing low of that candle. So we could look to place our stop loss here. And that's exactly what happened down here. We'll go back to the example that I showed you guys. But we're expecting price to hold this order block and propel price higher. So that you can see how these are like bricks being stacked. Say you're building a brick wall. You are stacking the bricks one on top of another, and you are supporting that structure to build that higher. So same thing here, and vice versa for a short setup. So you get a nice bullish down close candle, forming our bullish order block. As soon as we trade higher, trade above the opening price, and then we come back down. So and then we dig into it a little bit, form another down close candle, we come back up. So notice how these are line up, they're stacked on top of each other. So as soon as we break on this candle, let's move up here above this opening price of this candle's body, of this down close candle here, we go back down. As soon as we dig into that, we are in at the opening price. We're going to be in at that. And for this model, we are using that 62% retracement. So we are in at the opening price, and you'll see how that lines up. And then this will propel price higher. We'll get a strong move, strong displacement, strong expansion higher. So one more time, we'll go ahead and pull these candles up again. Notice, look at this example here. So these last 5 down close candles here, this is that initial order block. As soon as we come up, we get a strong displacement higher with a shift in market structure, breaking market structure here. We come down. Notice how these last 3 consecutive down close candles are inside of this order block. So what happens now? We get a strong move up, keep moving higher. Notice how this one digs into it, and it comes. We get a move higher here, but price isn't ready for that. This model, we don't just get in on that on the candles open, on the opening price of the propulsion order block. For this model, we are using the optimal trade entries. That's what this series is. This is the better entry. This is why it's called the optimal trade entry, because it gives us the optimal price to get in at and the optimal stop loss placement. So if we can get in at the 62% at a discount, we are able to reduce the stop loss from entry distance. We're able to increase our risk to reward ratio, and we are able to get a potentially better high quality setup. So if we could be in here, but we could potentially we would have, as soon as we got this move higher, we would have had to be in a little bit of drawdown as soon as this move came down. And I know some of you guys will typically, once you get a little move up, you'll put your stop loss at break even, and that's, in my opinion, that's incorrect, because price can come back to your entry multiple times and then actually go into the direction you were favoring. So to me that's a rookie mistake. You do not trail stops until you have at least 1 to 1.5 R, preferably for me around 1.5 to 2 R. But as you can see here, this is our ideal move. We wouldn't be in here. We would wait for that 62%. We got our bullish order block here, which is also a propulsion order block, so it would be this one here. And as soon as we come down into it, we dig into it a little bit and we run higher. So this is what we saw here. This is going to propel price higher. That's why it's called the propulsion order block. So we'll go over these a little bit more as we progress into the series. Hope you guys enjoyed this one. Like and subscribe, and I'll see you guys in the next one.